Hello, and thank you for joining me with this DipIFR video. Today we're going to run through some tips and guidance to help you be successful with your exam. My name is Jayne Howson and I've been preparing students for ACCA exams for a number of years. Today we're going to be looking at the topic of hedge accounting. Hedge accounting comes under IFRS 9. And I'm not here to reteach the whole of IFRS 9, but I do understand that some students find the topic of hedge accounting a little confusing. So I want us to go through some basic principles, go right back to basics on accounting, and think about why we account for things in the way that we do. And that might help you get to grips with this rather tricky subject. So what we're going to do first of all is I am going to remind you of what a financial instrument is, and in particular the financial instruments that we use for hedging. Now, hedging means minimizing risk, and we want to think about the sorts of risks that we have in an organization, because if you understand what the risks are, this will help you understand what the instruments are doing. And if we understand what they're doing, we can then account for them using some basic accounting principles of matching and substance over form. So we'll think about a little bit about hedge accounting principles. I'm not going to run through all of the conditions and characteristics. You can learn those. I will mention them, but you can learn them in your own right. But what I do want to do is to go through some relatively straightforward examples to help you see how the hedge accounting works. Now, before we start, let's think about what a financial instrument is. Now, a financial instrument, as you know, is a contract between two parties, and it gives rise to a financial asset in one organisation and a financial liability or an equity in another. Simple examples might be a receivable, where somebody owes money to somebody else. It's an asset in one company and it's a liability in another. It can also be an investment. An investment can be where somebody has acquired something in one entity and it's their equity share in another. Now, I'm not here to talk about general financial instruments. What I am concerned about is one type of financial instrument called a derivative. And derivatives are often used to try and minimise our exposure to risk. Now, I need to think about, first of all, what the characteristics of these are. Some organisations use them speculatively and not for hedging purposes. So IFRS 9 does actually tell you how to deal with derivatives that are in or out of the money. But to make sure that we understand hedge accounting, we're going to be thinking about derivatives that are used for hedging purposes. Now, they have three characteristics. Number one, they have very little or no initial value. Now, some of them do, I must admit, but most of them have a relatively little value, all of them in fact, compared to the value of the transaction that you're hedging against. They may have a teeny tiny transaction cost when we set them up, but generally it's not very much. And their value changes in response to the change in an underlying commodity. So, for example, if you have a derivative that is based on the value of silver, as the value of silver changes, so does the value of your derivative. And they are always settled on a future date. So let me give you a very simple example. Let's say that you are concerned with the price of wheat. I'm not an expert on the price of wheat, but let's say that you're not prepared to pay any more than $10 and you're worried that when you come to buy some wheat in 2 months' time, the price of the wheat will have gone up to more than $10 and you want to fix it at 10. So what you do is you enter into an agreement with the supplier, we'll call it a forward fixed rate, and you are going to agree to buy the inventory at $10, regardless of what the price of it is at that time. When you set up this forward, you might pay a teeny tiny transaction cost, but it's got little or no value. And the value of that forward will change as the wheat price changes. If the price goes above $10 and you've agreed to pay 10, then it's got value to you. If the price falls below $10 and you've agreed to pay 10, then it's got no value to you. But the value does change as the commodity wheat changes. And it will be settled at a future date because you would have agreed with the other party that you will pay on a certain day. Now, I would learn that definition in case you're asked to define. So why do we have these derivatives? Well, we know that we're trying to eliminate risk, or we're trying to minimize risk. Risk can come in many forms in exam questions. It can be about a commodity price like wheat or gold or oil, or we can be worried about the price of a foreign exchange contract. For example, we've got an invoice from a supplier and it's in euros. And by the time we come to settle that, we're worried that the euro-dollar exchange rate moves and we end up paying more than we thought we would. Now that gives risk to this transaction. And what we're trying to do with the derivative is fix the amount that we're going to pay or receive. Now we can do this using forwards with my wheat example, but there's also an instrument called a future. They work in a slightly different way to forwards, but they have the same outcome. They fix the amount that we will pay or receive for selling goods or selling currency or buying goods or buying currency at a future date. Now, I have to stress at this point, I am not a corporate treasurer. I'm not interested in how these work. I'm not interested in who I've got these agreements with. I'm the bookkeeper when I'm doing financial reporting, and what I'm interested in is how these are reflected in the financial statements. And what we need to do in the financial statements is show the substance of these transactions, which is the fixed amount that we will pay or receive. Now, hedge accounting is the way that we account for these hedging instruments. Some companies will enter into derivative agreements not for hedging purposes, purely for speculative reasons. I'm not interested in that. I'm going to be assuming here that our hedge accounting is needed because I've got a hedged item, which is a transaction. It's some inventory, it's a receivable, it's a payable, and I've got a hedging instrument, which is my derivative. And I want to demonstrate in the financial statements how that instrument works. What does it do? I need to reflect the fact that it fixes. Now, I'm allowed to do this when there are certain conditions that have been met. Now, you will always learn these anyway, but we know that it has to be designated instrument and designated item. Item is the transaction, instrument is the derivative. And we also need to show that this is fairly effective, which they usually are. In other words, they do make sure that they minimize the risk that we're exposed to. So why are we hedge accounting? Well, we're hedge accounting to show the substance of the transaction. We need to give a faithful representation of the risk that we're exposed to and what this derivative instrument is actually doing. So to make people understand what's going on in the financial statements and how this works, we're going to be showing how that instrument sets off the movement in the hedged item. Now, as you know, there are two types of hedge that we need to be aware of. What's important for you in an exam question when you see one is to identify which of these we're talking about. And I'm going to give you some hints and tips as to which one it's going to be. We have a fair value hedge, and a fair value hedge is a hedged item and hedging instrument where we have a recognized hedged item, which can either be an asset like a receivable or a liability like a corporate bond, or maybe it's going to be a supplier's invoice. They can also be unrecognized firm commitments. This is where we have signed a contract and something's definite, we've just not done it yet. I'll ignore that for now. What I want you to look for is something that's going to go in the financial statements. Now, if we have a receivable or a payable at the moment, and we have taken out a derivative instrument to offset against that, we know this is a fair value hedge. What we're going to do with a fair value hedge is we are going to recognise the item, we're going to recognise the instrument, and we are going to match or net off the movement to show this fixing. With a cash flow hedge, notice the difference here, and you're going to look out for this in questions too. This is where we do not have a current recognised item. We have a highly probable forecast transaction. It is the hedged item, but we just haven't recorded it in our financial statements yet. So, for example, if the question says to you, a customer has placed an order, it's very likely to go ahead. You know that as soon as somebody places an order, that does not go in the financial statements. Now, we might already be hedging against that and sorting it out, but we haven't done it yet. Another example might be, let's say that you run an airline and you want to buy oil, you need to buy fuel, and you're worried about the oil price. You haven't bought the fuel yet, but you are trying to fix the price of oil now before you actually make the purchase. That would be a cash flow hedge. So in an exam question, if you've got something in the financial statements, fair value. If you haven't, probably cash flow. Now let's have a look at some examples to see how these work. Now, you may be asked to explain these. And I'm going to run through a series of journals. Now, the reason I always do that is I think even if you're explaining things in financial statements, sometimes writing down the journals helps you sort out what the transactions are. But don't forget to put the words in too. Now, here we have an example of a fair value hedge. Edited highlights. Sam is buying gold, worried about the price changing, has a futures contract. I'm going to give you a couple of seconds, maybe pause the video at this stage and have a little read through on your own. So, having read through, you probably noticed the dates. 1st of January, Sam's buying this gold and he's paying $100 an ounce. We're looking at $2 million being paid for this gold, but we're looking to sell it after our year end of March. Now, what we have to do here is we have to sort of break down the timing. In the question, the timeline's not very clear, is it? But we start with January. We have a year end in March where the price of gold has gone up, which is great. And then by the end of June, which is when we actually make the sale, the price of gold has gone to 105. Still higher than the 100, but not as high as we wanted it to be. So this future of 110 has been entered into with Sam in January, so he knows that they're going to get 110 in due course. Now let's work through the journal entries. On the 1st of January, now we know that we said before that a derivative is something that has very little or no initial value. I'm not told I've paid anything for this future at all, so it's got no value partway through the year. But I am going to record the purchase of $2 million worth of gold, 20,000 ounces at 100. When it comes to the year end, I have to now value the inventory and the financial instrument, which is the derivative or the future. Now, usually, if I wasn't doing hedge accounting, inventory would be recorded at the lower of cost and net realizable value. And I would not record any movement of up or down values at all. But if you have hedge accounting to demonstrate the matching of the instrument with the item, I am going to revalue the inventory and I am going to show a value for the derivative. Now, watch this. The derivative is now got a value of 100,000. Why? Because I know that my initial value was 110, and that's going to fix the value of my gold at 2.2 million. But the inventory at the moment is valued at 115. So at the moment, my inventory's got a value of 2.3 million. Now, it means that the derivative is losing me value. At the moment, I could sell that gold for 2.3 million, but the future fixes that for me at 2.2. So it gives me a liability of 100,000, the difference between the two values. And the other side of the double entry is going to be shown as a loss. Now, I wouldn't normally value inventory, as I said, but what I am going to do is to show the offset of this. I'm going to debit the inventory. I'm going to show the increase in the inventory from the 2 million to the 2.3, and I'm going to reflect that in the P&L. Now, when it comes to the actual transaction date, the value of the inventory has now fallen to 105. So 20,000 ounces at 105 is 2.1 million. But the future has fixed it at 2.2. Now, this means that I'm guaranteed selling it for 2.2 million. This now has value for me. So that derivative has now been converted from a financial liability to a financial asset, giving me the difference between 2.1 and 2.2 million. And the other side, the double entry, is going to be reflected in the P&L. But the inventory has fallen in value by 200,000 from 2.3 to 2.1 million. And again, although I wouldn't normally show the value of the inventory, I am going to show the change in the value of the inventory. Now, the matching concept comes in because you can see that in the statement of profit or loss, these gains and losses are being matched against each other perfectly to show a perfect value of the inventory that's being sold. It is reflecting the substance of this transaction. So always in your head, work out the bits that we've put in bold here about what's actually happening with that forward, and then you can work out the transactions. Now, a cash flow hedge is one where we said before we have got a highly probable forecast transaction. And in this example, which I'm going to let you read through in a moment when I've stopped talking, this transaction is where we've got Sam again, who's got a customer this time who's placed an order. Notice the difference between placing an order and having inventory. This is not a recognizable item until the transaction actually occurs. But if a derivative is taken out in expectation of that transaction, we need to record the value of it. Otherwise, that wouldn't reflect what's going on in the business. But what am I going to do with the double entry? So have a little read through this one for me. Maybe pause the video and then you can have a read through. Okay, so here we can see that at the beginning of the year, Sam's customer puts in an order for 1.2 million dinar, but the delivery of the goods and the payment of the goods are not going to occur until October, much later in the year. Now, we've got this 31st of March year end again, so we can see that this transaction straddles the year end. And Sam has arranged a forward contract to sell 1.2 million dinars for 1.25 exchange rate. Sam is fixing the amount of money that he gets on the 1st of October 20x1. Sam knows today that if he took 1.2 million dinars and divided it by 1.25, they would get 960,000 dollars. They know that now. So what we have to make sure is that in the financial statements, we reflect that cash figure of 960,000 on the 1st of October. What we also need to make sure is that we show the movement in that derivative until that date. And you would have noticed as you read through that the exchange rate has gone to 160, so that the dollar has really appreciated there, and then it's gone back down slightly to 150. So let's again work through the transactions and let's see what we do on each day. Now, this time on the 1st of January, I haven't got a transaction. I've not bought anything. I've not sold anything. I've got nothing to record. And again, because I've not given you any information about the transaction cost, there is absolutely nothing to go in the financial statements. But then I get to the year end. Now, there's no order yet. I've got the order, but there's no goods yet. There's no delivery. There's no sale. But this forward has actually changed in value. And what I need to do is to reflect the derivative on what that's got in terms of worth to me. Now, I said to you before that if you took the 1.2 million dinar and you divided it by the 1.25 exchange rate they fixed at, he knows he's going to be receiving 960,000. But that 1.2 million dinars today at a 1.6 dinars to the dollar exchange rate would only give them 750,000. So at the moment, this has really got some value for me. So my derivative now becomes an asset because it's in the money. And if you look at the difference between the 960 and the 750, you can see that we've got an increase in value here of 210,000. But I've got nothing to match it against. I've got no order, no sale, nothing. So the other side of the transaction has to go to other comprehensive income because I can't put it in the P&L at the moment. So it sits there until we get to October. Now again, think about what this is doing. The forward is fixing the sum received. So somewhere I've got to reflect the cash coming in at 960 and I've got to reflect the revenue coming in at 960. So the P&L has to show what this transaction's actually doing. So first things first, the exchange rate has moved to 150, which means that at the moment, the financial asset has only got a value of 1.2 million divided by 1.5. It's only got a value of 800,000. So actually, what I've got to do is to make sure that this financial asset drops from 960 down to 160. So I'm going to take off 50. And to do that, I'm just going to reverse a little bit of the transaction. I'm going to put a debit through OCI and I'm going to credit the financial asset. So I'm bringing the asset down to 160. I'm then going to record the sale because we're told in the question the sale takes place. The money comes in. I have to reflect what actually happens. The cash we receive is 960 because I've fixed the exchange rate. And the revenue will also be recorded at that. So at this stage, I'm putting through the difference between what the exchange rate is on the date of the invoice and the actual money received, 160,000, as part of my revenue. But I then need to recycle and get rid of that OCI. So I'm going to take out of the OCI the 160 that I previously recorded, and I'm also going to remove the financial asset that no longer exists because it's been closed down. Now notice again what we're doing here in the question. We're making sure that we understand what the transaction's doing, these bits that I've got here in bold, and then what we're going to do is we're going to reflect the financial journals through that. Now, a few tips for when you're dealing with hedging. And I know this sounds really obvious. Please don't ignore it. Do something. Just sit and look at it and say, what is this doing? I need to reflect this in the financial statements. Look at the scenario. Is it a recognized transaction? Fair value hedge? Is it a forecast transaction? Cash flow hedge? Consider what the derivative is doing. It is fixing the amount of money that you will pay or receive for goods or in foreign currency. Think about what the financial statements need to reflect. Make sure that you show the sale or the cash at whatever value it needs to be. And then work through from the initial arrangement all the way through your journal entries to get to your conclusion. I hope you found that helpful. Thanks ever so much for listening, and I wish you all the best for your exam.